Welcome back, and this is part 2 of health insurance. We're going to start this with private sources of health insurance and healthcare. Private insurance companies. This is the more general way to talk about these. These are the ones you get through your employer, where you can get your individual policy, your group policy through private insurance companies. Now, we also have hospital and medical services plans. These are, you can call them add-ons or this coordination of benefits that we spoke in the previous video. You may have heard of Blue Cross and Blue Shield. These focus on hospital care benefits. That's Blue Cross, and Blue Shield on surgical and medical services benefits. So things to get familiar with, what's available out there, and what you can, how you can combine them on the private side. We're going to talk also about health maintenance organizations, HMO. You hear about these on the news all the time. HMO this, HMO that. It's a form of managed care. It's a prepaid health plan for comprehensive health care to members, best known as HMO and PPOs. Now, like I said, you probably heard of HMOs a lot in the news, or people talk about like that. But then you got PPOs, which we'll talk about here in a moment. But it's an option similar to HMO, but with some extra features, you could say. And then you also have primary care physicians and those managed care approach. Now let's talk about this health maintenance organization, the HMO. These are contracts with selected care providers. So that's why you have to be in network, is what you typically hear. They don't use the services. Fixed prepaid monthly premium. Focus is on preventive care, basic and supplemental services. The key part here is basic and supplemental services to understand what you're getting from an HMO. Now, what this does is contracts with selected care providers, and this focus on preventive care is how they're able to keep the HMO premiums a little lower or more affordable, if you want to call it that way, but at the same time, there's some trade-offs. You're giving up some stuff. Now you got the preferred provider organizations. So this would expand the providers you can choose from versus the HMOs, which in turn is why it's going to cost more than an HMO. Specify services at predetermined fees to PPO members. So not for everything, but most things will have like already a fixed amount that you know is going to cost you for XYZ service. If you go to a non-PPO provider, you pay more. Similar to an HMO, if you're out of network, you end up paying more. Includes EPO, POS plans, point of sale. Other options: home healthcare agencies, home healthcare aid and hospices. Just what they sound like, they're hospices and home healthcare aid. Then you got employer self-funded health plans. Okay, so let's go read this. Company collects premiums and pays medical benefits, may not have the assets to cover medical costs that exceed premiums. This is what that means. Some organizations are large enough that it's cheaper for, instead of engaging in a contract with a health insurance company, what they do is they say, okay, look, employees, you pay us a premium similar that you would do with a healthcare insurance company. Is more than likely going to come at a reduced cost. And what happens is the company is large enough that they can act as the insurance company. So whenever an employee has a medical need, then the company just pays for it directly instead of going through an insurance company. So they're behaving just like an insurance company. However, there is a bit of a risk to the employee or the patient in this case, if all of a sudden many employees start having health problems, and then those health problems are high cost, then the company itself all of a sudden may not be able to afford covering these medical expenses, and then this starts becoming an issue. So something to think about. You want to be familiar if the company you work for is doing employer self-funded. Some companies do somewhat of a combination where it's mainly employer self-funded, but then what they keep is a contract with a company on the side that if the overall cost start exceeding what they can afford, then the third party company kicks in and starts covering it. So things you want to be aware of. So you know what you're dealing with when you get in these health plans. New healthcare accounts that are out there. Well, this says new here, new in the broader picture, but they've been around for quite a bit. Health savings accounts, health reimbursement accounts, flex spending accounts. These are things that for example, you're in some of these plans, you're allowed to start saving money in an account that is pre-tax, so you don't get taxed on it. So on your income. And but then you're limited to only use it for medical expenses or qualified expenses related to medical needs. So those are some examples. Government healthcare programs. Now we outside the private sector, we're talking about within the government. You probably heard of Medicare, Medicaid. Let's go ahead and talk a little bit about those, understand the differences. So Medicare is a federal program for those age 65 or older. So there's a senior citizen thing and certain disabled persons. So you don't have to be a senior citizen if you have certain disabilities, similar to Social Security, where after certain age you can collect, or if you have certain types of disabilities. So we have the Part A and Part B. Part A is the first tier, the first level is hospital insurance. You get inpatient hospital care, inpatient skilled nursing facility care, home health care, hospice care. Then Part B is like an add-on that you can get medical insurance, and it's voluntary. You don't have to. And pretty much is to cover any doctor services not covered by Part A. Then let's continue with Medicare here. You got Part C and Part D, Medicare Advantage plan. After Part B, you are electing to participate in these if you want to. It's not mandatory. Medicare prescription drug benefit. These, like I said, may come at a premium. You pay a little bit to get those covered. Then you got Medigap or MedSup insurance. May pay what Medicare doesn't cover in any other Part A, B, C, and D. So, but you will be paying for that extra coverage. Then we have Medicaid, which is for low-income individuals and families. It's administered by the state with federal guidelines. So the federal government oversees it, is administered by the state, and how funding goes there, then that's a different story. Individual share responsibility provisions require you and each member of your family to have minimum essential healthcare coverage every month. So just like it says, individual shared responsibility. So now you're looking at a family type plan, family approach, but there will be a minimum coverage that you have to buy. Have an exemption from the responsibility to have minimum essential coverage, or make a shared responsibility payment when you file your federal income tax return. So you have to qualify in certain ways. Disability income insurance, I will start by saying this is typically a very expensive insurance to add, but what does it do? Disability income insurance protects your most valuable asset, your ability to earn income. So if you become disabled, you want to be able to collect a paycheck. Disability is more likely than death at any age. And this is part of the problem why it's so expensive. At least death, the probability does change with age, and they can predict that better. And once you pass away, if you collect life insurance, for example, which is not related to health or disability, then there's that one payment and it's done. However, disability, if you end up being disabled at a young age, you can be on disability insurance payments for decades. So it becomes very expensive. So therefore, the premium will be expensive. provides regular cash income lost as the result of an accident or illness. If you become disabled, your income drops, but your medical expenses go up. And that's why it's important to do that. But I'm about to do that to consider disability insurance. Definition of disability. Some policies define it simply as the inability to do your regular work. However, please be very, very familiar what your insurance company and your contract will consider disability. Good disability plans pay when you are unable to work at your regular job. Poor disability plans pay only when you're unable to work at any job. Meaning, if you are, let's say, an engineer or a medical doctor yourself, your earning potential is really high. So a good disability plan will cover that earning potential. A poor disability plan says, okay, maybe you're a doctor or surgeon and you hurt one of your hands, but you can still work in some other much lower paying job because you can't perform surgery anymore. Pick any job you want to picture in your head that doesn't pay anywhere near a surgeon. They can perform by only having one hand. And they say, nope, you can work, no disability check for you. So you want to be careful. You want to read the fine print there. Disability insurance trade-offs, waiting or elimination period, meaning that you want to start collecting disability right away, not wait for it. And you don't want to get bumped off for XY reason. Duration of benefits, that's important, all the way from only a few years to a lifetime. So keep in mind that if you get this, you become disabled at a young age, the duration would be of high importance. Amount of benefits, of course, accident and sickness coverage, guaranteed renewability. You want to always keep this in mind as you get involved in these policies. Sources of disability income, employer. Group disability plan may be short or long term. Many employers offer the add-on to disability. It doesn't mean they fully pay for it, but they may subsidize it. However, you will notice the difference in payments a month. Most insurance limit benefits from all sources to no more than 70 to 80% of your take-home pay. So they're gonna, when they say all sources, let's say that because of your disability, you start receiving Social Security. That's going to become part of that 70 to 80%. So they want to pay out as least as possible. So they're going to supplement all your sources. Social Security covers total disability that lasts more than 12 months, and you must be unable to do any work. Workers' compensation applies if your accident or illness occurred at your place of work or resulted from your type of employment. So do understand that if you did not get injured at work, but you're disabled, you can still collect disability insurance. But if it was at work, then workers' compensation comes in play. Now, that's important because the disability insurance income is capped at 70 to 80%. So workers' compensation comes in first, then Social Security and any other forms, and then the disability insurance kicks in after that. That's it for this video, and we will see you in the next one.